Uncertainty. What is uncertainty? Under high uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk because there is a huge credit risk because there was huge NPAs during that COVID situation and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see, the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So, adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have Civil over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata's or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is that? Difficulty to select a healthy company from the riskier company. It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level, we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at a CIB level, it is what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So these are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether the loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing a difficulty in paying the normal rate of interest also. Okay. Or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations, means my employee errors or my system failure or my region failure, area failure. Area means what? There's a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear, simple. Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you a question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it mutual fund? So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk, that is important. Now if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero, okay. But if I invest in mutual fund, there is the risk involved in it. So this risk factor I'll have to consider using my this other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay. Suppose if you are buying Reliance right now, Reliance share. Okay. You are buying a Reliance share at let's say 2500, expecting it to go up. Okay. But if it goes down, then to cover this downside potential or downside risk, what do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost because put option doesn't come for free. So this will carry the cost. So this is known as the risk, amount of risk, and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk to cover my risk. Okay. So this is for to cover the downside. I'll buy a put, and this put will cost me something, and this will be known as my risk capital, which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So all these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series right now. What are you watching right now? Free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay. Risk adjusted return on capital, REROC. What is REROC? Have you heard this term REROC? Type yes in the comment section. Have you heard this term before? REROC. Type yes in the comment section or no. Whatever. Yes or no. So it is. Yes, I've seen many of them. Yes. Okay. So risk adjusted. We have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here. It does this by accounting for any expected losses and income generated from the capital, with the assumption that the riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, REROC. So same as this earlier, we have seen one earlier definition just now. Similar to this, higher the risk, I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So It does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment, okay. Same example. Suppose if I am investing in FD or in mutual fund. So definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So, what do you mean by this? Here, managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. Analyzing, forecasting, and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. Here, this is called as long position. Long means, suppose if I buy a Reliance share, Reliance, okay, at 2500, expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the this derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk. And this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only, okay? Short means deposits. If my bank's deposits will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I am having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, it says, suppose if I am having a loan or if I take a deposit of, let's say, deposit, okay? If I take a deposit of, let's say, 1 year, of, let's say, 1 lakh, okay? And I have to give a loan against this. So the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share and this Reliance share now, this Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay. So that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay. That is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer, everyone. 2,500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then, yeah, 25 crores. Yeah, it'll be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we need for clearing JIB and CIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIB also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to, let's say, 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. Indicates how much the investor stands to lose, how much this investor will lose if this downside potential means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide the guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange, and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See, this guaranteed clearing over here means it is called a settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay, you sell, let's say, shares to anyone, shares, okay. So this other person, Mr. X should give you rupees, right? Rupees, because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part. Provides a guaranteed clearing and settlement function for transactions in money, government securities, forex, which I gave you. The shares, settlement risk of the shares. No. The comment section. Who takes care of the, who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange, and derivatives market. 4 clear. Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay. Yeah. Like that, there are some. MasterCard was having an ad a few years back that there are some things which money can buy, and for everything else, there is MasterCard. Similarly, over here, only share settlement risk is taken by NSE and BSE. For everything else, there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise-wide risk measurement or risk assessment. Enterprise-wise means what? Enterprise-wide means total related to enterprise. complete company wise. EWRA or M you can call it assesses the risk of anti-money laundering, counterfeit, counter-terrorist financing means AML and CTF and sanctions. In addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay, so money laundering, AML, counter-terrorist financing. Okay, means terrorist financing. Okay. Then second is counter proliferation financing. Okay, this is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this even bribery and corruption is part of this enterprise-wise risk because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all the inclusive elements of EWRA or EWRM, right? Remember, whenever you are talking of enterprise-wide risk measurement, it means you are talking of the whole company, not of a specific section. Okay? Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory, questions, objective questions and some numericals. So let's start without wasting the time. This is not numerical. Numerical means it's a case study actually. The same case study you get it in the exam. Similar, exactly the same many times. So in on one sure it is from your textbook only, huh? So don't worry, it is not out of your textbook. So there are more chances of these case studies coming in your exam. On 1 June, customer request to book a forward contract for retirement of import bill for USD 1 lakh due for payment on 15th September. Given the spot USD INR rates as 75.2729, forward premium as given as spot for June is 10 to 12, spot for July is 21 to 23, spot for August is 30 to 34, spot for September is 43.45, and August to 15 September it is 6.7. So charge the margin of 0.2% on the spot rate. So how to solve this numerical? Such a big numerical. This numerical will be for 5 marks. They'll ask you various questions in this. Very numerous questions. There can be many questions which can be asked from this. But once you are clear in the concept, you can definitely solve all the questions. So firstly, what is the forward contract? Okay, forward contract means immediately remember it must strike your mind that whenever we say forward contract, I'll mark this line over here because my video is over here, right? So whenever I say forward contract, it means forward contract. It means I'll have to use the forward rates, bill rates. Remember this, bill rates. Okay. This is something you must always remember. Whenever I'm talking of forward contracts, I'll have to use bill rates. Okay. Whenever I'm talking of spot transactions, I'll have to use TT rates. Here, I'll give you the classification over here. Spot transaction, you'll have to use the TT rates. Okay. Now, if I'm talking of import transaction, import, okay, import, then I'll have to use which rate? I'll have to use sell rate, sell. If I'm talking of export transaction, export, I'll have to use buy, okay, buy rate. Always remember, only in case of crystallization, it's reverse because crystallization is actually the reverse case. But don't worry about crystallization in this case study now. So import we are talking of sell, export we are talking of buy, forward we are talking of bill rates, spot we are talking of TT. Okay. Now I'll ask the questions also to you. Not only I'll answer, but I'll ask the questions also. Now based on this, tell me this contract, what is given about this contract over here? On 1 June, the customer books a forward contract for retirement of import bill. Retirement of import bill means what? The customer has to pay that import bill, pay to that customer. And that payment is to be done when? On 15th September. So this customer has come to you when? This customer has come to you on, okay, let me draw it on the other page, let me see. But before going ahead, everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, remember, you will be getting the latest updates from IIBF on JIB and CIB. Updates means they give various notifications. This subject change, that subject change, this portion change, this timing change, this venue change, all these. So these are immediately updated on this this channel. Number one. Number two, what you will be getting is very importantly, so yeah, you will be getting the free YouTube series on all the subjects, free YT series, okay, of CAIIB as well as JIB. So join it immediately, and whatever is free, grab it fast. Click on the bell icon, click on the like button, okay, share it with your friends, okay. Chalo, let's start this numerical. See, it is, what is the numerical actually? See this, I'll draw it over here. Firstly, let me draw a line over here. Otherwise, what happens? It goes behind my video. Okay, here, okay, now, yeah. So this is the, this is what June 1, June 1, June 1. Now the customer has come to you for booking the contract for what? September 15th, isn't it? Look at the date. September 15th due date. So September 15th means you'll have to book this September 15th over here. Let's mark it September 15th over here. So this customer will have to pay to this, his buyer, his seller on September 15th. He is booking the contract today. Okay. So I'll have to book for this gap. This is known as a forward transaction. Okay. Now September 15th will come in between what? September 1 and September 30th. So September 1 and September 30th. So everyone amongst you over here, remember, those who are thinking, those who have learned something, buy low, sell high, maximum, they are using it, don't use it. Okay. Why don't use it? Because the reason is the rates are already given over here. Look at this. If you look at the forward rates, it is given, this last rate is August to 15th September. So exact rate is available for 15th September. So when exact rate is available, you need not do buy low, sell high. Buy low, sell high is done when the rates are available of September 1 and September 30th. But you don't know the exact rate of September 15th. Then we'll do buy low, sell high. But here we have the exact rate of September 15th. It's already given. So now get the forward rates of this forward rate we want, exact forward rate we want it now. This one. How to get this? Start from June. Okay, whatever we have, start from the basic. What is the June rate we are having? June spot is given as 75.2729. Now I'll ask you the question. Okay, is it 75.27 or 75.29? What will I take? 75.27 or 29? What will I take, everyone? Should I take 27 or 29? It is import transaction. Fast. Let me see in the comment section. We don't have time. It is 75.29. Import. Import means sell. So sell means right side. 75.29. Okay, this is the rate I'll be taking. Okay, now I want September 1. What is the September 1 forward rate? Are you having it? See, the spot is given for June. Now, whenever I say June, it means June end. Remember this. Whenever I say July, it's end. August end. Okay, September end. Okay, so this my transaction is on September 15th. So I can't use this September end rate. I'll have to use the August end rates here. August end equals to here. August end. It's equal to September 1. September start. Okay. This is like the closing cash and opening cash of your bank. What is the closing cash for yesterday is the same as the opening cash for today, isn't it? Volt cash. So same logic is used over here. So August end equals to September start. So I want it for September 1 now. So that will be August end rate. So I'll be taking 32, 34. Which one will I take? 32 or 34? Should I take 32 or 34? I'll take 34, right? So now tell me, this is 34, okay? Now tell me whether the currency is in premium or discount over here. Everyone, type in the comment section, 10, 12, 21, 23, 32, 34. So is the currency in premium or is it in discount? What do you say? It's in premium. Remember, when your right side is higher, right side is big, okay, in forward transactions, the currency is in premium. Always remember this, premium. When your right side is big. So why 0.6 and 3? 75.63, right? Add this. How many of you have got this? 29 plus 34. 33, 43, 53, 63, isn't it? This is one, but I want it for September 15th now. So what will I do? I'm having this rate up to September 1. I'll take the forward points for September 15th now. What are the forward points given? 6 and 7. Okay, this one, 6 and 7. Seeing this? 6 and 7. So what will you take now? 6 or 7? Everyone type in the comment section. You will take 6 or 7. I'll take 7 because sale. But I won't take only 7. It is 0.7. 0.07 because we require after point 2 digits. So 0.07. So what is this now? Again, premium or discount? Premium. So I'll add this. So it will be 75.63 plus 0.07. So 75.70. This will be my rate for September 15. Exact rate for selling. Okay. Selling. But is this a final answer? No, this is not the final answer. Why? Because I have to charge this margin also, TT margin. Where is it mentioned? We have not mentioned anything about the TT margin. So what is the TT margin then? Say this, TT margin is always taken like this. Whatever rate you get, 75.70 into what is that? 0.2%? What is it given? 0.2%, right? So 0.2 upon 100. 0.2 upon 100. So what is the answer you're getting? Try it on the calci, everyone. Everyone should be able to do this now. Fast. Everyone should be able to do this. Fast. Try it on the calci. What is the answer you're getting? Everyone. Yeah. Let me also try along with you. So getting 0.1514. Right? This is the answer you might be getting. Right? 002. So 0.002 into this. So 0.1514 you are getting. Are you getting this? Everyone type yes in the comment section if you are getting it. Are you getting the same answer? Okay. Chalo, move on. So this is my margin. So what to do with this margin? Remember, whenever you are selling, you'll always add the margin, TT margin. Huh? And whenever you are buying, you'll always subtract the margin. Okay. So now what am I doing? I am doing the import transaction, means selling. So I'll add this. So what will be my final rate now? 75.70 in plus 0.1514. So what is the answer you are getting? Add it. So let me see the answer from your side. It is 75.7 plus 0.1514. Everyone tried 75.85. 75.8514. This is the exact answer you will be getting. And this is your final answer. Okay. But what do you mean by this rate? What has happened actually? In this whole transaction, you have got the rate. But what has happened? This much amount you will be debiting it to the customer. See this 75.85 because $1 lakh are to be given. So what amount will you be debiting to that customer? So 75.8514 into 1 lakh. $1 lakh, right? 1 lakh. So whatever that amount is. So it is around 75 lakhs, right? That much will be the amount, isn't it? Yeah, into $1 lakh. So multiply this. So you'll get something 75.8514 lakhs. This much amount you will be debiting to the customer and then passing on the $1 lakh to the next party in foreign. Okay. So this was the actual case study. In exam, how will they ask you? They'll ask you various questions. They'll ask you, okay, what is the spot rate for June to be taken? Okay, what is the September 1 for this forward rate? What is the September 15th forward rate? Will you be using buy low, sell high in this exam, in this question? So these all questions will be asked to you and you must be prepared for that. For that, you must have studied this case study. Okay. Before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, everything you'll be getting. Okay. Whatever we need for clearing JIB and CIB, we get it over here. So that's why everyone download this app immediately and start studying. Okay. Second numerical. Now this is not a simple one, a confusing one, but let's see how many of you can answer this. A forward purchase contract USD 5 lakhs booked 2 months back at 75.25 is due for delivery 2 days later. The customer is informed by the drawee of the bill that the payment will be delayed by 1 month. Now this much is your case study. See here, there is a contract which was booked. Okay, 2 months back means I'll write it over here. See this. 2 months back, there was a contract which was booked for due for tomorrow. Means here, let's say tomorrow. Okay, here it is tomorrow. So 2 months back. What is this month now? Let's consider anything. This is September. Okay, so gone August and July. So July. Let's say the contract was booked. It is due in September. This tomorrow's date. Let's say. But what has happened is customer is told now by his buyer. See here, forward purchase contract. This is a purchase. Purchase means it's an export transaction. Always remember, purchase is always export. So this buyer has told, buyer means what? The buyer of your customer. That buyer was going to pay the customer on September. But this buyer has said that no, I won't be able to pay you now. I'll be able to pay you after 1 month. So I'll be able to pay you in October. Now what have you to do? In this case, what have you to do? This contract was already here. This is contract number 1. So this contract number 1 was booked over here. Okay. So if it is booked, it has to be nullified over here, cancelled over here, cancelled. Here, the rule is very simple. Whatever is booked has to be cancelled, or either it has to be paid or it has to be cancelled. So if it has to be cancelled, it's like the same rule. जिसको आना है वो जाएगा, right? Simple rule. The one which rises will always fall. The one which is booked will always be cancelled or paid. It will be equated. Okay. So this is to be cancelled. But remember, if it is to be cancelled, it doesn't mean because the payment is to be received in October. Is the payment received up till now? No. Payment is not received. So what will I have to do as a banker? This now the role of the banker comes in. The banker will have to cancel transaction number 1 and will have to book a new contract. Book new contract for October, this 1 month, because up to the time payment is not received, the transaction is not over. Okay, so the bank will have to do 2 transactions over here. One is cancelling the older one and booking the new one. Okay, now let's look at it. So rate of booking of the original contract is means when it was booked in July, at what rate was it booked? TT buying rate. Okay, let's consider this A, B, C, D. A, B, C, and D. So now, when the contract was booked in July, at what rate was the contract booked? TT buying, TT selling, bill buying, or bill selling? What do you think? Purchase contract. Purchase means what? It will be buying. Okay. Purchase means buying. Buy. So if it is buy, then what? Now the answer is only two. Two are remaining. Either TT buying or bill buying. So which one? Just now I told you in the first numerical. Whenever you are booking a forward contract, you will always use which rate? Bill rate or TT rate? Just now. Just go to the part of that video again. You will be taking bill rate. So the answer will be bill buying. So the original contract was booked at bill buying rate. Remember this. This bill buying rate is 75.25. Okay. Second question. Rate of cancelling the original contract is what? TT buying, TT selling, bill buying, bill selling. So cancelling. This cancellation means this. Cancelling transaction number 1. This one. This is to be cancelled when? It is due when? Tomorrow. Tomorrow means spot. Always remember. This is spot. So here I'll have to first use spot. Spot means what? Whenever we are doing a spot transaction, which is to be rate is to be used. Again, first problem. Just now I gave you. Spot you have to use in the comment section. Let me see. Spot you have to use TT rate or bill rate. Okay, I'll give you options. TT or bill. So which rate will you use? TT or bill? TT rate, correct? So TT is okay. So now these two are out. TT is only in. TT buying or TT selling. Now I'm cancelling the contract. So if the contract was booked at what rate? It was booked at the buying rate, right? So originally it was booked at buying rate. So cancellation will be done at what rate then? Will it be buying or selling? So if I do something at buying, I'll have to cancel that using selling, right? So I'll be using bill, this TT selling rate, right? So the answer will be TT selling rate over here. Okay, cancelling is always done at the reverse rate of the booking. Okay, then you'll say why not bill booking, bill selling then? But because bill selling is not used, bill is used whenever you are doing some future dated transactions. Here I'm cancelling tomorrow itself. So it is a spot transaction. So TT, isn't it? A rate of booking the new contract for next 1 month. So next contract will be booked at what rate? TT buying, TT selling, bill buying, bill selling. Who can give the answer? New contract for 1 month now. Simple logic. You have the answer only here itself only. You have the answer here. Let me see the simple logic you can give. See here, contract number 2 which is booked is same as contract number 1. Because there also I had booked it for purchase. Again I'll have to book it for purchase because same thing is repeated. This full whatever had happened in July is repeated on over here now. Same thing is repeated. So if it is repeated, then the rates will also be repeated. So it will be again bill buying rate. So I'll be using bill buying rate. But the rates will be different. Of course, not the same rate, but the logic is same. I'll be using the bill buying rate only again. Again, new contract. Of course, the rates will be for today, whatever the rates are. Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory questions, objective questions and some numericals. So let's start without wasting the time. So, fintech. First definition, fintech means what? Fintech refers to the synergy between the finance and the technology. See here, sometimes they call it fintech and there is a separate word called as techfin also. Techfin. Okay. So techfin and fintech, these are not same words. Fintech means first finance and then technology. Finance plus technology. So basically this company is in finance and then it is using technology. But techfin over here means the company is in technology. Understand the difference? Technology and then it is doing finance. Okay. Now you'll say, sir, what is the difference? Only words are the different over here. See, the difference is like this. Suppose SBI. SBI will fall in fintech. SBI, HDFC Bank, all are banks. They are fintech. They are first finance, then technology. Techfin means what? Google. Google will fall in techfin because it is first technology and then it is giving loans. Phone Pay. First it is technology, then it is giving loans. Google, Phone Pay. Okay. So these are all the techfin companies. Understand the difference. There is a slight difference in the words, but huge difference in the overall companies. Okay. So finance plus technology. Fintech refers to synergy between finance and technology. Okay. Second one, regtech. Now, what is this regtech? See, here the words you can break it up over here. Reg means regulatory. Reg plus tech. So, reg refers to regulatory. Technology in regulatory aspects, focusing on automation of the compliance processes for the banks, right? So, automation of the compliance. What do you mean by automation of the compliance? What is this? Okay. See here, I'll give you simple reason, simple logic behind this. Compliance. Let's talk of simple terms like large cash transaction report. Again, large cash transaction report means any transaction about 10 lakhs of cash, right? So in large cash transaction report, why has a bank or the employee to report it? As you are having the technology over here, right? So immediately it should be reported. It should catch which is the large cash transaction report and give it, isn't it? So that is known as automation. Similarly, for this bill of entry also in trade finance. Now, those who have covered this batch, those who are in the batch, they'll understand the SDF form and BF form. BEF. I told you BEF entry is now BEF report is now removed, right? Why? Because of this automation in the technology. Means bill of entry, whatever is coming in, why should it be reported separately now? Once it's in the customs office, you get it through their system, it is automatically reported to RBI, isn't it? So automation means reducing or removing the manual work in the compliance part at least. Okay? Because compliance, always the problem in compliance is if there is a human intervention, always it faces the problem. There is some error, some manual error. So if it is done by machinery, nothing as such. What has happened in clearing now, isn't it? What is clearing? Clearing is gone now. It's all automation now, isn't it? AI, artificial intelligence. It refers to the simulation of human intelligence in machines that are programmed to think like human beings and mimic their actions. Understand this, programmed to think like human beings. You'll say, sir, how can a machine replace a human being? Of course it can't. No machine can replace a human being. But if you look at your banking activities, what are you doing in the banking? Tell me. If you look at the banking activities, just tell me one answer. Everyone give me the answer in the comment section. Give me one answer. How much part of your job is repetitive in nature? Repetitive means daily you are doing the same job. Same job, same desk, everything. So how much part of your job is repetitive? I'll give you two options. One is almost 90% of your job, and second is 10% of your job is repetitive. Every time it's a new job. Right? Give it in the comment section. Everyone write in the comment section. How much part of your job is repetitive? Correct. Almost 90% of your job is repetitive. 90%. Because daily you can't have new things, isn't it? Will you have daily new challenges? No. We'll have repetitive job almost every day. Some days some new thing comes. Okay, so whatever is repetitive, that can be done by the AI. Here, simple thing is, whatever is repetitive can be handled by the machines. It's that simple. Okay, and mimic their actions. Mimic means rehearse, means do it again. Okay, so AI basically whatever you are seeing right now, chatbots. What are chatbots? Chatbots we see everywhere nowadays. You go to any site and you see, may I help you? Then you type in that message and then you get chatbots. So now chatbots have gone to the higher level. Now we have something called as chat GPT. So chat GPT, what do you get over there in chat GPT? You get various other things also. Not only this replies, but also you get the this artificial intelligence helps you to find the answers to the repetitive questions of the customers. Okay. Next is machine learning. Machine learning refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history, behavioral pattern, advisory services, etc., thereby enhancing the customer experiences with the banks. Now, what do you mean by machine learning? Here, machine learning is known as learning by the machine. It refers to the algorithm by analyzing millions of data sets to provide inputs to the banks. So, learning by the machine means this is called as there's a word in machine learning that is called as cognitive. This word you will hear many times. Okay, cognitive, TIVE. Okay, cognitive means continuous learning. It refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history. So, whatever are the customer transactions, whatever are the behavioral patterns of that customer, advisory services. So, all these things, basically behavior patterns. Here, if you see the behavior pattern of any customer, at least in the financial field, by that you can definitely govern which products are to be sold correctly to that customer. Okay, thereby enhancing the customer's experience with the banks. So if the customer receives proper treatment or proper advice as per the customer's requirement, then definitely what happens in that case, the customer will stick more to your bank rather than giving some vague. Means, for example, I'll give you, suppose if any customer is requiring, let's say, loan. Okay, he is facing some financial problem and you are trying to pitch to that customer insurance or mutual fund. These are investment products. So will that customer come for this mutual fund or investment with you? No. That customer requires a loan, so you have to pitch in the loans. How will you know? whether that customer requires a loan or not through his or her behavior pattern. Okay, behavior pattern means if that customer has asked for the loans, or if there is huge cash withdrawal or transfers from that account. So that is all captured under AI now and machine learning. Okay. So it refers to the usage of algorithm. Remember this word algorithm. What is algorithm? Algorithm is a set of computer programs. Okay, done. Computer programs. Okay, which make this machine think on the repetitive jobs. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates on JIB and CIB. Number one. Number two, you'll be getting all the free YouTube series on JIB and CIB earlier. So subscribe to it, click on the bell icon, click on the like button, click on the share button, share it with your friends, isn't it? What is big data and data analytics? See here. Big data deals with the data sets that are too large or complex to be dealt with the traditional data processing application software. Now, what do you mean by this? See here. Many times in your computer itself, we see our own computer, your home PC it might be, or in your bank PC also. The computer operator or the admin guy, systems administration, when that person checks your computer and he or she says, your data is too much loaded, your server or your CPU does not support it, your laptop doesn't support it, memory is too much gone. What is that? What is that person saying actually? That person is talking of big data. See here, every machine has its own capacity. Again, suppose if I want a huge data analysis of entire banking industry, I can't keep it on a single PC or even a simple server. For that, huge servers are required, right? So big data deals with data sets that are too large or complex to be dealt with by traditional data processing application software. Okay. Big data is advantageous where volume, variety, and velocity of the data is huge. Now understand the three words, very important. Okay, volume, variety, and velocity. Velocity means speed. We require huge speed. Okay, science graduates might understand this. Okay, velocity is speed. So volume, variety, and speed. All the three things are required and they are huge. Volume is huge means if you consider SBI, what will be the volume? If you consider your own bank, forget SBI, your own bank, what will be the volume? Per day volume. It will be huge. So a server needs to cope up with such big volume. Variety. There are thousands of transactions, variety of transactions. So all the variety needs to be captured in your system. Similarly, velocity speed. If you imagine in the bank, if when you are using your system, and if it takes around 1 minute to answer, even 1 minute is a long time in front of that customer. Waiting for 1 minute is a huge time. Okay, so that's why it needs to be at a huge speed. That's why we have all these 4G, 5G, 6G, all these things. Okay, got it? Data privacy and digital privacy. Now, what is this data privacy? See this. These words many of you might be knowing now by now, isn't it? Privacy means secrecy, right? Digital privacy, same. Okay, digital and data both mean one and the same thing. So, data privacy or digital privacy refers to the protection of an individual's information that is used or created while using the internet on a computer or a personal device. So what do you mean by this? Refers to the protection of individuals' information. Individuals' information. Okay. Now what all information can the individual have? Individual will be having various informations like name, mobile number, that is common thing, address, right? But like graduate, what is your education level? Then what is your family size? Are you holding any assets, car or anything? Okay. Plus, have you taken any loans? So these are all the individual informations. Remember, individual information can be of two types. Always remember, it will be of two types. One is static, and second is dynamic. Okay, dynamic. Static means what which does not change. Means what your name, generally your name, your address, or your Aadhaar number, these don't change. PAN number, they don't change at all. What is dynamic? Are you holding a car? Are you holding some loans? These are all dynamic things, right? Education level is static generally, because once you are educated, you won't change your education. Yeah, generally I'm talking, huh? Somebody can do the changes in that also, okay? So static and dynamic means that, okay, refers to the protection of individuals' information that is used or created while using the internet. While using the internet means whenever I fill up any form for Google, or if I fill up any form for your bank, online form. So if that form, it gives my all the details and that is breached, that is shared by your bank, let's say, with someone else. So what is that? That is affecting my privacy, isn't it? While using the internet on a computer or a personal device. Personal device means anything related to computer or laptop, mobile also. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing the JIB and CIB, we'll be getting it over here. So that's why download it right now. Okay. Data breach. What is data breach? Sure. Just now we talked about data privacy. Importantly, remember these are all the important questions, and you'll get some of them, at least two or three of them, two at least out of this series, whatever we are talking right now. Today's session, you'll get at least two 1 mark questions in your exam. Okay. So now you know, everyone among in CIB knows the difference between 1 mark, the importance of 1 mark. The difference is 49 and 50, right? 49, 50 is cleared and 49 is not cleared, isn't it? So data breach. Data breach refers to the security incident in which malicious insider or external attackers gain unauthorized access to the confidential data or the sensitive information, such as medical records, financial information, or personally identifiable information. Now, data breach means what? Just now we discussed about static and dynamic, right? Dynamic means what here? This security, generally this dynamic information is very sensitive, because static information generally everyone knows. Where are you staying? What are you doing? Okay, all these things which don't change. This generally everyone knows. What is important is dynamic. And all the companies want this dynamic data, because it is changing. It is changing, and what happens? Your habits are changing accordingly. So data breach refers to security incident in which the malicious insider. What do you mean by malicious insider? Insider means that person working in the bank itself. That person compromises the data and gives it to some other external company or external attackers. External attackers means what? These are all those attackers, these cyber attacks. Okay. So these cyber attackers or these insiders gain unauthorized access. Unauthorized means even the banker can get unauthorized access. Suppose if you are in the branch, do you have the access to the head office data or sensitive data, balance sheet and everything? Do you have access to that? No. That is, if you have access, you are in the branch, you have to get access only to your part. So that is known as unauthorized data. If you get information about something else which is not required by you, so that is known as unauthorized data. Okay. So unauthorized access to the confidential data or the sensitive information, such as medical reports, financial information, or personally identifiable information. So medical reports, sure, that's what I said. These all things are dynamic. If you check this, these are all dynamic, right? Dynamic means what? They go on changing. Dynamic, right? Medical reports, they go on changing. Financial information changes. Personally identifiable information, right? So these are all the changing things. Okay. So mainly the access to this is required by the companies so that they can sell the various products to you. Okay. P2P lending means a financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. P2B means peer to peer. This is known as peer to peer, or in simple you can call it peer to, it's two, peer. In simple way, peer. You can call it peer, people to people. P2P lending is an important aspect coming. This P2P lending will change the entire banking scenario. Remember this. So, financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. So, P2P lending will change the entire. See, right now, what is happening? Why are people depositing money in the banks? Because they don't know who is to take, who wants the loan, and they don't have the confidence on that person who will get the loan, right? Suppose if I get somebody, tomorrow you require the loan, okay, you require, let's say, 1 lakh rupees, and I'm having excess 1 lakh rupees. So why should I deposit it in the bank and then that bank gives you the loan? I'll directly give you. So that is known as P2P lending. So there are certain problems in that, but those can be tackled nowadays. There is account aggregator system that can definitely tackle it. So it means secured and unsecured personal loan, the person who wants it with the investor, connecting this buyer and seller. It's that simple. Cloud computing. It refers to the delivery of computing services, including servers, storage, databases, networking, software, analytics, and intelligence over the internet to offer faster innovation, flexible resources, and economies of scale. Cloud computing, you must definitely know this definition because this is the important part of technology in international banking. Computing services including servers, blah blah blah, storages, databases, software, analytics over the internet. Now remember, over the internet means this is the server will not be a physical server, it will be in the cloud. You might have seen many of these, right? Many of the companies have come like that. What GoDaddy, right? There's a company called as GoDaddy. Check that, okay? That is giving online servers. Okay, there is many of them are there. One I know because I've used that data. Servers, storage, databases, networking, software, analytics, everything on the internet. There is no physical existence. To offer faster innovation, flexible resources, and economies of scale, right? Clear? So everything is on internet over here. There is no physical thing. Okay. Now, to join, as I told you, join this Adda 24/7 app, download this app, or join the YouTube channel. But how to join it? See, just scan this QR code right now. This blue QR code is for Telegram channel, official Telegram channel. Scan it. For all, you might be in JIB, you might be in CAIB or any other bank promotion. Similarly, YouTube. Scan this right side QR code, this one, okay? This QR code. Then if you want to join this Instagram, okay, join this QR Instagram. Okay, scan this QR code and you'll join this Instagram channel. Remember, there are many fake channels available. Fake channels. So we need not join those. Okay? Because here in the world there are always copycats, right? So that's why join it immediately. DigiBank, an entire bank squeezed to fit in your smartphone. DigiBank, there is no physical existence of that bank. Remember, there is no physical existence of that bank. There is only one head office and there are no branches. DBS has started DBS. They have started DigiBank. Many of the Indian banks have also started DigiBank. No physical branch, only head office, and that's it. Regulatory sandbox. This is a new definition. It refers to an environment where it allows the regulator, the innovators, and the financial service providers and the customers as final users to conduct field tests to collect evidence on the benefits and risk of the new financial products. So, where regulator, innovator, and the financial service providers. Now look at this. All these elements, these are all the we call the stakeholders. Regulator, innovator, financial service provider, customers as the final user to conduct field test to collect evidence. So field test is collected. Important part over here is field test. Okay, conduct field test to collect evidence on the benefits and risks of the new financial product. So whenever I'm launching a new product, what are the benefits of that? Will it be harmful? Will it suffice my this purpose? So that all evidence is collected using this regulatory sandbox. Okay, understand this word is very important. Conduct field test to collect evidence on the benefits and risk of the new financial products. Robotic process automation. It refers to the process of assigning manual repetitive tasks to robotics instead of humans in order to streamline workflows in financial institutions. So it refers to what? The process of assigning manual repetitive tasks to the robotics here. Assigning repetitive tasks to the robotics instead of human beings. So robotics instead of human being. That is the basic logic behind this robotics process automation. So human beings should not be used for repetitive jobs. Human beings should be used for innovative jobs. Okay. Blockchain technology. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Okay. So blockchain is basically recording information. Recording information. Okay. Questions, objective questions, and some numericals. So let's start without wasting the time. The yield to maturity of a bond is same as, so this YTM is same as what? Now I'll tell you something. Say this. In any bond, remember, in any bond, there are 5 elements. Always remember, there are 5 elements. Out of these 5, 3 are static. Now look at this. Static means what? They don't change at all. Let anything happen, they won't change. And 2 are dynamic. Okay, D. Okay, dynamic means what? They will change. Now which one are the static ones? So remember this face value. Face value, or it is called as par value also. Some books call this par value. Face value. Then second is period, N, period. And third one is coupon. Coupon, what is coupon? Sure, coupon is a fixed interest which I'll be paying on that bond. If you compare this with FD, then the rate of interest which your bank gives, is known as coupon. So these 3 are static. Which is the dynamic one then? Dynamic means first one is market price. Market price. Look at this, price of the bond. And second one is market rate. Both are market. Okay, market rate. Okay. So these 2 are dynamic. Now what do you mean by dynamic? Understand the term. Dynamic means if both of them will change basically. Now there's a rule to this. Now rule is what? If the market rate goes up, the price will go down. If market rate goes up, the price will go down. Okay. This scene you had seen in this October to December 22 in USA. You check right now also. Go on Google and check October to December 22 bond rates of USA. You'll find the same problem. The market rates were going up and the market price was going down. Now what is the question? But your YTM, where is this YTM? YTM is nowhere over here. Where is YTM? So this YTM is called as market rate. See this, there are 4 to 5 names to this YTM. YTM will be called as YTM, yield to maturity, or second one is rate, this market rate, R. All of these are called as R. Okay. Next one you call it discount rate. Discount. Any name can be given. Discount rate. Next one you call it discount rate. Then asking rate. Asking. Okay. So any name can be given. So the YTM of any bond is same as present value of the bond, future value of the bond, the bond's internal rate of return, and none of these. So what is this equal to always? Remember, the present value of the bond, present value formula is totally different. Future value, that formula is also different. Bonds IRR, this can be thought of. So this is, you can call this as IRR also, internal rate of return. So what is YTM? YTM means when I hold any bond, buy any bond and keep it up to the maturity. Understand this, say this. Suppose I buy this bond today and keep it up to the maturity. Maturity means I'm not selling that bond till the end. Okay. So I'm not selling this bond. So I buy this and say keep it up to the end. So what will happen? What will I get in this? I'll get one coupon. Every year I'll be getting some coupon, year or 6 months, whatever is decided, right? So I'll be getting the coupon, fixed rate of interest, and in the end I'll be getting the complete face value also. So this is known as bonds internal rate of return, or it is called as YT. Clear everyone? Concepts are clear. That is important. Okay. Type yes in the comment section. Type yes if you have understood it. So that I'll go ahead. Okay. We'll see here. It's not important that I'll cover many questions, 20 questions. But just covering the questions, yeah, YTM is same as bonds internal value. Okay, next 20 questions. What's the use? You are in CIB. You are not in JIB level. JIB level you can learn. CIB you can't learn. Okay. CIB you have to understand. Okay. Risk is defined as uncertainties resulting in adverse outcome, adverse in relation to the planned objective or expectations. Now this is simple. It won't take much time, isn't it? Adverse variation of profitability or outright losses, both A and B, and none of these. This is quite simple. See, a risk means what? Uncertainty. Basically, remember, risk means uncertainty. Uncertain. That is known as risk. But uncertain in what direction? In your unfavorable direction. Remember, anything in your unfavorable direction is a risk. Suppose if, let's say, I buy, you only, let's consider one simple thing. You buy a flat tomorrow. Let's say you buy it for 40 lakhs. Done. Now the value of that flat goes up 40 lakhs to 70 lakhs. Are you at risk? No, not at all. Risk is when the value of that flat goes down 40 lakhs to 30 lakhs. Then you are at risk. So unfavorable. So what is the answer over here? Quite simple. A, adverse outcome. Reverse. Adverse means not in my favor. Adverse variation, not in my favor. So answer is both. Isn't it? How many of you have got this right? At the end, what do? You tell me a score. Whatever I'll be giving, see this earlier one, this one, and this one. You tell me a score also. Okay? Next one. Financial risk is defined as financial risk. What is the financial risk? See here, financial means what? Related to finance. Okay? Financial risk is defined as uncertainties in the cash flow. Uncertainties in the cash flow. Second, variations in the net cash flow. Uncertainties resulting in outright losses and all of them. Simple one. Let me see how many of you are right over here. Let me see your answers first. Uncertainties in the cash flow. Is it a financial risk? Variations in the net cash flow. Uncertainties resulting in the outright losses. Which one is the correct one? What do you think? Let me see. How many of you have typed this? Is it A, B, C or D? It is D. Correct? D. Correct? Yeah. Okay. One sec. Yeah. Let me change it to its mod B. Okay. It's mod B. So, move on. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever you want for clearing the JIB and CIB, you'll get it over here. How to download it? We are having a QR code. It's given in the comment section below. Okay? Scan that QR code. You'll join our Telegram channel. You can join our YouTube and Instagram also. Follow us on all these three. Okay? So download right now this app also. Okay? Uncertainties in cash flow, cash inflows or outflows can create uncertainties in net cash flow, profits, both A and B, none of these. So uncertainties in cash inflows or outflows, both. You'll say, sir, inflows is okay, how come outflows? See, both are the same. Suppose if sometimes my outflow is, let's say 1 lakh and next month and my outflow is, let's say 1.5 lakhs. It's an uncertain. Similarly for inflow also. So it will result in what? Can create uncertainties in net cash flow, profits, both A and B. Obviously, isn't it? Both A and B. See, how many of you have written it correct? Type in the comment section. Have you got it right? Yeah. Which of the following is not correct? Now see here, in exam you have to always check what is asked. Sometimes they will ask you what is correct, sometimes they ask you what is not correct. So sometimes they ask you which one is false. So you have to tick the right one. That's why you have to read the question properly. So which of the following is not correct? Lower risk implies lower variability in net cash flows. So lower risk means lower variability. What do you mean by this term? Lower risk, lower variability. Is it true? We want not correct. Okay, let me get the answer from you, then I'll explain. Higher variability in net cash flow may result in higher profits or higher losses. Higher risk would imply higher upside or downside potential, and none of these. So, higher risk, here, first one, lower risk means lower variability. So, that is true? Yes, that is true. Why? Because if my cash flow is less, means the variability is less, 1 month I get it 1 lakh, next month I again get it 1 lakh 1,000 or 99,000. So that's variability is less. Suppose 1 month I am getting 1 lakh, next month I am getting 2 lakhs. After that month I am getting 0. So that is higher variability. So that will be a higher risk. So this is true. We want false, isn't it? What is our target? Our target is false. Higher cash variability in net cash flow may result in higher profits or higher losses. So higher variability. Sometimes I am getting huge cash, sometimes no cash. So it may result in higher profits or higher losses, both. That is true again, isn't it? True, isn't it? Higher risk would imply higher upside or higher downside. Higher risk, higher upside or higher downside, right? Have you seen this day trading in stock market, in options or futures? Mainly these two only, options and futures. You'll see this sign. Higher upside, higher downside. Anyone is just type in the comment section if you have done the trading in bank nifty trading. Anyone has done? There you'll find it. Higher upside, higher downside, higher risk. So that is also true. So which is false then? None of this. All of them are true. Okay, all of them. Generally in exam, we have a habit that none of these will never be true, means never be the answer. But remember, this is CAIIB. In CAIIB, you can't guarantee anything. You can get none of these answers also. Okay? Because remember, higher variability means may result in higher profits and or higher losses. Higher risk would imply higher upside or higher downside. Okay, that is the basic logic of this ALCO department. What is the ALCO department in the bank? Okay, asset liability management. So it basically deals with this higher upside and higher downside. Okay, yeah. Uncertainty with regards to interest rate at which future cash flow could be reinvested. Now, with regards to interest rate at which future fund cash flows can be reinvestment, basically we are talking of reinvestment. Means what? Suppose if I am having an FD, let's say today, I am having an FD at FD, okay? I am having at let's say 8%. This FD is for let's say 3 years. So what is reinvestment risk or what is the risk in this? After 3 years, will I be getting the same rate of interest of 8% or higher or higher, or will I be getting 8% or lower? So this is known as which risk? Will I be getting the same rate or higher or lower? So it is reinvestment risk, interest rate risk, gap or mismatch, none of these. What is it now? Name itself. नाम ही काफी है, नाम ही काफी है. We have a dialogue ना in Hindi. बस नाम ही काफी है. Reinvestment risk, isn't it? That is the answer. Whether you will be able to reinvest this money at the same rate or higher or lower, that is basically the risk, isn't it? Right? Here you'll say, what is this FD? We are talking of BFMs here. In BFM, remember, all your bonds are similar to FDs. Now tell me, what is the difference between bond and FD? Difference is not much. Okay? Bond equals to, I'll just give it to you simple. Bond equals to negotiable FD. Remember, negotiable FD. Because what is FD? FD is not negotiable, right? FD is not negotiable. Now, what do you mean by negotiable? If I have a FD, okay, in your bank, tomorrow if I send my brother or tell my brother that what do? You take this FD and go into the bank and get the money in your savings account. Will you give him? Will you give him that? Okay, you have brought this FD, so we'll transfer it to your account. No. How many of you will give him? Tell me. No, because FD is not negotiable. FD money is given only into that account of that same account holder. But bond is slightly different than FD. That's why, what did I say? Those three elements, static and dynamic. These dynamic ones are bonds. Means that is the difference between bond and FD. Otherwise, these three terms, static ones, are same as that of the FD, isn't it? This one, what was it? This one, yeah. See, this for these three terms, bond and FD, both are same. This is the only part which changes bonds. Bond changes because of this. This is not available in FD. So that's why bond equals to negotiable FD, isn't it? Got it? So where were we? Yeah, over here. So reinvestment. Got it? Subscribe to Officers Adda 24/7 YouTube channel. As I told you, join this channel immediately. Subscribe to it. Click on the bell icon. Here you will be getting the latest updates on IIB from IIBF on CAIIB and JIB. Means update means whatever are the changes in the subjects or timings change, then what venue change, many things you get it. Okay, so all these changes. So one is updates. You will be getting the updates, and second, most important, second is free YT series. Free YT series. Right now, what are you watching? You are watching the same free YT series. So same free YT series, you will be getting it over here. Okay. So that's why subscribe to this Officers Adda 24/7. Join our LinkedIn. See this, not LinkedIn, Telegram. Okay. Join our Telegram. Then YouTube and Insta. All the three you have to join. Why? Because on all these three we provide all the questions also, free question banks, free tests. Okay, plus videos are available on YouTube also, and all of these they are posted. So that's why subscribe to it right now. Click on the bell icon. Where the bank borrower or the counterparty fails to meet its obligations regarding the terms of agreed with the banks, it is called as, here counterparty is failing. Counterparty fails to meet its obligations. So what do you mean by this? Counterparty is failing. Market risk, operational risk, liquidity risk, credit risk. Type fast in the comment section. Is it A, B, C, or D? What do you say? Counterparty is failing. Means what? Say in your case only, you have given a loan, and the party over there, the borrower, is unable to pay you. So what is that? Is it market risk? Somebody is typed market risk. No, market risk is not the same. It is credit risk. Remember, it's credit risk. See here, I'll tell you something. Credit risk always is of, mainly, I'll tell you, there are many types, but mainly there are two types. Okay, one is counterparty. And second is this country risk. Okay, one is counterparty, second is country risk. Always remember, credit risk is of two types, counterparty and country. Okay. So counterparty means what? Your other party is not paying. Here, it means simple logic is over here. Suppose if your party, counterparty means you have sold the goods. Okay, you are the seller. Okay, seller. And this counterparty is a buyer. Okay, buyer. Now imagine your counterparty is in USA. Okay, your buyer is in USA. So what does it mean? Your USA country is good. Are there any legal problems in USA? No, nothing. Europe, no problem. Only the problem is your party is bad. It can happen anywhere. Okay. So this is counterparty. Country is good, but the counterparty is bad. Second is this country risk. Your counterparty is good. Let's say your buyer is in Afghanistan. Okay. Or second case, Pakistan also nowadays. Pakistan. Even Sri Lanka, even Bangladesh has the same problem. See here, many of the countries have restrictions on transfer of dollars. Okay. So if you have this problem over here, then your counterparty may be good, but the country is bad. Your counterparty is ready to send you the money, but the country has put the restrictions. So that's why this is known as credit risk. Okay. When the bank chooses a wrong strategy or follows long-term business strategy which might lead to its failure. So wrong strategy for the future. It is known as what? Credit, operational, market or strategic. This is a logical question. This is less related to CIB, more related to business. Yep. But this risk is there in your CIB. It is called as, what is this? A, B, C or D? Credit, ops, market or strategic? Long-term strategy. Okay, I'll give you an example. Nokia. Nokia. You all might have seen those Nokia phones some 5, 10 years back, right? 10, not 10 now, 15 years back, isn't it? 2008. Nokia was the market leader in mobile phones. At that time, it was thought that Nokia will never die, as during the British time, it was thought the sun never sets in the British Empire. Similarly, it was thought that Nokia will never die. But what happened to Nokia? Gone. Nokia is gone. Why? Wrong strategy. Strategic risk. Same thing happens with the bank. When the bank chooses the wrong strategy, it will go down, collapse. Okay, in the long run. So that's why this is known as strategic risk. Always remember this. Return on zero investment would be dash as compared to the opportunities available in the market. So return on zero investment, zero risk, zero risk investment. So zero risk means what? What do you mean by zero risk? Suppose if I keep the money, I'll give you two options. Suppose if I keep the money in nationalized bank FD, let's say SBI FD, SBI FD, okay. Or second is I keep the money in stock markets, stocks. What will happen? This SBI FD is safe, something 6-7%, whatever I'll get it, okay, roughly. That is safe. But what about the stocks? These stocks might give me, let's say, 30% also, or 0% also, or minus 30% also, isn't it? So that's why this is riskier element. But returns are also the same way. Higher the risk or higher the returns. Always remember, high risk equals to high returns. Always remember this logic. Okay, high risk equals to high return. So what will be the answer over here? Return on zero risk investment would be dash. High, low, medium, high or low, depending on the type of the investment. What is it? High or low, depending on the type. Somebody is typing this D. See here, if it is higher on the type of instrument, then it becomes the riskier element. We are talking of zero risk. Zero risk will always be low. Treasury bills, T-bills are zero risk instruments. Okay. Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. It is, which is the wrong one? Wrong one is this. The last country to join ACU is Myanmar with effect from 2010. Myanmar is not the last country, okay? Myanmar has joined long back in 2003-4 almost, 2-3-4 at that time. Remaining all are correct. There are 9 countries in ACU, okay? Settlement takes place through ACU dollar or ACU euro. Both of them are there. Separate dollar or euro account is to be maintained. So we need to have a separate ACU dollar account or ACU euro account with the banks which we deal in within these countries, these 9 countries. Okay. Now there are these 9 countries. I can tell you some names: India, Pakistan, Burma, then Myanmar, Nepal, Iran, 6, and there might be 3 more. Okay. So these all 9 countries form together the ACU unit. Okay. Export declaration form is not required to be submitted by the exporter if the value of the export consignment is. So EDF is not required to be submitted if the value of the export which is to be made is up to USD 1 lakh, up to USD 50,000, up to USD 25,000 and up to USD 10,000. Think over it now, everyone. Yeah, the answer is yes, everyone. 25,000, right? USD 25,000. So EDF is not required to be submitted if the value of the exports is up to USD 25,000. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel right now, because in this channel you will be getting the latest updates of from IIBF. Number one, number two, free YouTube series on all the subjects of your JIB and CIB plus other bank promotion exams. So click on that bell icon, subscribe to it immediately. Okay. Form ETX is used by. So ETX, where is it used? AD when they extend the time period of pre-shipment loans. AD when the post-shipment loan is written off. Exporter while seeking the extension of time for realization of export bill. Exporter for seeking extension of time for extending the period of pre-shipment loan. Now, what can be the answer of this? When they extend the time period of pre-shipment loans, or written off, or extension of time for export bill, or pre-shipment loan. Think over it. How many of you have started the studies? Tell me. Sincerely tell me. How many of you have started the studies? Type in the comment section if you have started the studies. Give me the answers also in the comments only. If you have started the studies, tell me. Have you started the studies? Everyone? Type yes. Yeah. So the answer is over here. What is the answer? Think. Is it pre-shipment? Is it written off? Is it extension of time? Is it that pre-shipment loan, extension for pre-shipment loan? Think over it. This is a difficult one. That's why you'll have to think more. The answer is ETX form. See this. ETX full form is extension form. Extension. Actually, it should have been EXT, but they call it ETX. Extension. The extension is always received for realization of export bill. Whenever your export bill is not realized within the time, now what is the time period? It is generally, earlier it was 12 months. Now because of that COVID, RBI started 15 months. Okay. So if your bill is not realized within 15 months, then you'll have to submit the ETX form to RBI through the AD, means through the bank. Okay. The credit directly extended by the overseas supplier to the of goods to the importer is called as. I told you I'll be discussing this supplies credit when the subject topic comes. Okay. So now think over it. What did I tell you? I'll be discussing the supplies credit when the topic comes. So now the topic has come. See this. What did we discuss earlier in buyer's credit? This was a buyer. Buyer was from India, right? Buyer was from India. He arranged for the credit from USA. Some bank he arranged. Bank. Okay. Bank. So bank gave him the loan. Okay. And then what did he do? By getting this loan, suppose loan was received from this bank in USA. So this loan is received by this buyer, and this buyer paid the supplier immediately. This buyer paid the supplier right now, immediately, today only. Okay, this was paid immediately. Okay. Now the difference between supplier's credit and buyer's credit is, here this bank is not giving the loan, so this is not there. Only this part is there. So here what will happen? This immediately will not be there. So this supplier will be supplying to this buyer with a credit period. Credit period means the supplier will be supplying for, let's say, 2 months, 3 months duration. Means I'll give you the goods now, you pay me after 2 months. So whenever any goods are sold on credit, on udhari, then that is called as what? Credit directly extended by the overseas supplier. So that is called as buyer, supplier, trade and ECB. Answer is simple. ECB, supplier's credit, right? Again remember, buyers and suppliers are the part of trade credit only. Okay, remember this. Got it? Next one. No person in India can import or export unless she has obtained the following: import-export code number from DGFT, authorization for DGFT from DGFT, authorization from RBI, import-export code number from RBI. Now this is a simple JIB question. Okay, let me see how many of you can answer this. Got the answer? So it is import-export code from DGFT. This IC code is required by each and every person who wants to import or export in India or from India. Okay, compulsory. The supplier's credit extended by the overseas supplier for a period of more than 3 years is termed as. Again confusion in this. Here options are the same again: buyer's credit, supplier's credit, trade credit and ECB, external commercial borrowings. What is it called as? Just now when I discussed a buyer's credit, I told you something. What was that? Think over it. Again, rewind this video, go back. So I told you that it is ECB, external commercial borrowing. Whenever any loan is beyond 3 years, it is called as ECB. See here, it's simple. Okay, below 3 years, less than 3 years, and 3 years and above. What? 3 years over here. Okay, so it is ECB over here, ECB. and this is trade credit. Trade. Now this trade credit is of two types: buyer's credit and supplier's credit. Okay, this is a basic classification between all these. So the answer over here is D, ECB, external commercial borrowing. Okay. The decrease in value, foreign value of the foreign exchange rate, which is done during the market due to the market forces, is called as what? So decrease in value of the this foreign exchange, yeah, which is done due to the market forces, is called as what? Think over it. What will be called as? Now look at the options: appreciation, depreciation, devaluation, and revaluation. Quite simple to answer. Think over it. Think over it. What is the answer? Got it? You'll get confused over here. Decrease in value. Decrease in value means it is either depreciation or devaluation. Either depreciation or devaluation. Now the confusion is between these two only. Is it depreciation or is it devaluation? Now look at this. Foreign exchange due to the market forces. Market forces. Okay. Now this is a trick. This will separate this depreciation from devaluation. So think about this. I'll explain this. I'll give you the explanation also. Not to worry. It is, see here, whenever market forces do anything, it is called as depreciation. Market forces. Okay, I'll mark this over here. Market forces. And devaluation is done when? Then I think so. There's a next question. Let's see. Is it there? Let me see if the question is there. No. So now I'll answer here only. Okay. So if it is done due to the government pressure, government interference, okay, if it is done by the government, in that case it is called as devaluation. Market forces, it is called as appreciation and depreciation. If the price increases, then it's appreciation. If it decreases, then it's depreciation. Okay, got it? Simple. Next one. Which of the following is not the correct value of the domestic currency? Not the correct value. Okay, which of the following is not the correct value? Correct in value, not value. Correct in value of the domestic currency. Devaluation is done by the government. Just now I told you. Revaluation is done by the market fluctuations. Appreciation is caused by the change in demand and supply. And none of the above. Not correct. Think over it. Think over it again. Okay. What do you mean by not correct? Not correct. Okay. Devaluation is done by the government. Okay. So is this correct? What did I tell you just now? Appreciation, depreciation is done by the market forces. Devaluation and revaluation is done by the government. So this is correct. So this is true. But I want false. So this is not the right answer for me. Revaluation is done by the market fluctuations. This is the catch. Okay. So this is false. Right. Appreciation is caused due to the change in the demand and supply. So demand and supply, that is appreciation, depreciation. So that is true. So we want not correct. Not correct is this. B is the answer. Revaluation and devaluation are done by the government. They are not done by the market forces. Okay. Market forces do appreciation and depreciation. Okay. Again, everyone, subscribe to Officers Adda 24/7 YouTube channel. Also, download this Adda 24/7 app on your mobile. Both the things you should do it now. Okay. Which of the following is correct? Devaluation in value of the domestic currency is caused due to the fluctuations in the demand and supply. Devaluation in the value of the domestic currency is done intentionally by the government. Appreciation is done intentionally by the government. Both A and B. Yeah. What do you think? I am watching you. What should be the answer? Think over it. In the comment section. Give it in the comment section, everyone. Yeah. What is the answer? Yes, everyone. Devaluation in the value of the domestic currency is caused because of fluctuations. Devaluation is done by the government. Revaluation is done by the government. So this is false, right? So this is false. Devaluation in the value of the domestic currency is done intentionally by the government. Done. True. So one, I got it true over here. Appreciation is done intentionally by the government. Appreciation is done by the market forces. So this is false. Both A and B, that is obviously false. Okay, so the answer is B, only B. Okay, which of the following is correct? Only B is correct. Got it, everyone? Hi friends, welcome to the Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. Okay, so first question. The credit arranged by the buyer, importer, from a bank or financial institution outside India to settle the payment of imports is called as, now understand this question properly. The credit arranged by the buyer from a bank, okay, outside India. So buyer from a bank outside India means what? This buyer is from India. Understand this properly. These are important points, okay? This buyer is from India, buyer, okay? And now this buyer is arranging for credit from some bank in foreign, let's say USA, let's say Citibank, okay? Citibank. So this buyer is arranging for credit. So loan is given by Citibank to this buyer in India. This buyer contacts the Citibank and gets the loan. So this is called as what? Outside, to pay the settlement of imports is called as what? Means this buyer has to pay for imports. For that he is getting a loan. The loan can be got through two ways. One, through India or through outside. If he gets through India, then it's a simple loan. If he gets through foreign bank, then it's called as what? Buyer's credit, supplier's credit, trade credit, or ECB. Think over it, everyone. Answer it properly. After thinking properly, answer it. You'll get confused in two parts, I'll tell you. What are those? Okay, I'll give you the hint in this. Answer is between A and D. A and D. Now you think over it. Yeah, it is. Here the answer is called as buyer's credit. Remember this. Buyer's credit it is called as. ECB is also a part, means buyer's credit is a part of ECB, external commercial borrowing. But external commercial borrowing is above $20 million and it is above 3 years. Any loan taken from other banks outside India, okay, within 3 years and within 20 million by this buyer or any person is termed under buyer's credit. Okay. What is supplier's credit? I'll come to that later when the question comes. Okay. Trade credit means what? This trade credit is a, here, understand the concept again. Here, trade credit consists of two parts. It consists of two parts. Okay. One is buyer's credit, BC, and second is supplier's credit. Okay. So the whole term is known as trade credit. So whenever the buyer arranges for this credit, it is known as buyer's credit specifically. Which of the following is not correct regarding Asian Currency Union settlements? ACU settlements. Now what are ACU? ACU are the 9 countries in Asia which have formed something called as ACU dollar. Now ACU dollar is not a separate dollar. It is the same dollar, but it is done as a netting effect. Means, for example, if India sells to, let's say Myanmar, okay, Myanmar, okay, Myanmar. If India sells to Myanmar, okay, and Myanmar also sells something to India. India sells to Myanmar and Myanmar sells to India, both. India sells, let's say, $100 and Myanmar sells, let's say, $40. So the difference is called as $60, which is positive for India. That is known as ACU dollar. That is reported to the USA. That is known as ACU dollar. So ACU dollar is not different. ACU dollar is a netting effect. Okay. So which of the following is not correct? Now we want not correct. Huh? There are 9 countries in ACU. The last country to join ACU is Myanmar with effect from 2010. Settlements takes place through ACU dollar or ACU euro. Separate dollar or euro account is required to be opened to distinguish the ACU. So which is this correct one? Again think. Yeah. It is. Which is the wrong one? Wrong one is this. The last country to join ACU is Myanmar. Myanmar with effect from 2010. Myanmar is not the last country. Okay. Myanmar has joined long back in 2003-4 almost 2-3-4 at that time. Remaining all are correct. There are 9 countries in ACU. Okay. Settlement takes place through ACU dollar or ACU euro. Both of them are there. Separate dollar or euro account is to be maintained. So we need to have a separate ACU dollar account or ACU euro account with the banks which we deal in within these countries, these 9 countries. Okay. Now there are these 9 countries. I can tell you some names: India, Pakistan, Burma, then Myanmar, Nepal, Iran, 6, and there might be 3 more. Okay. So these all 9 countries form together the ACU unit. Okay. Export declaration form is not required to be submitted by the exporter if the value of the export consignment is. So EDF is not required to be submitted if the value of the export which is to be made is up to USD 1 lakh, up to USD 50,000, up to USD 25,000, and up to USD 10,000. Think over it now, everyone. The answer is yes, everyone. 25,000, right? USD 25,000. So EDF is not required to be submitted if the value of the exports is up to USD 25,000. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel right now, because in this channel you will be getting the latest updates of from IIBF. Number one, number two, free YouTube series on all the subjects of your JIB and CIB plus other bank promotion exams. So click on that bell icon, subscribe to it immediately. Okay. Form ETX is used by. So ETX, where is it used? AD when they extend the time period of pre-shipment loans. AD when the post-shipment loan is written off. Exporter while seeking the extension of time for realization of export bill. Exporter for seeking extension of time for extending the period of pre-shipment loan. Now, what can be the answer of this? When they extend the time period of pre-shipment loans, or written off, or extension of time for export bill, or pre-shipment loan. Think over it. How many of you have started the studies? Tell me. Sincerely tell me. How many of you have started the studies? Type in the comment section if you have started the studies. Give me the answers also in the comments only. If you have started the studies, tell me. Have you started the studies? Everyone? Type yes. Yeah. So the answer is over here. What is the answer? Think. Is it pre-shipment? Is it written off? Is it extension of time? Is it that pre-shipment loan, extension for pre-shipment loan? Think over it. This is a difficult one. That's why you'll have to think more. The answer is ETX form. See this. ETX full form is extension form. Extension. Actually, it should have been EXT, but they call it ETX. Extension. The extension is always received for realization of export bill. Whenever your export bill is not realized within the time. Now, what is the time period? It is generally, earlier it was 12 months. Now, because of that COVID, RBI started 15 months. Okay. So if your bill is not realized within 15 months, then you'll have to submit the ETX form to RBI through the AD, means through the bank. Okay. The credit directly extended by the overseas supplier to the of goods to the importer is called as. I told you I'll be discussing this supplies credit when the subject topic comes. Okay. So now think over it. What did I tell you? I'll be discussing the supplies credit when the topic comes. So now the topic has come. See this. What did we discuss earlier in buyer's credit? This was a buyer. Buyer was from India, right? Buyer was from India. He arranged for the credit from USA. Some bank he arranged. Bank. Okay. Bank. So bank gave him the loan. Okay. And then what did he do? By getting this loan, suppose loan was received from this bank in USA. So this loan is received by this buyer, and this buyer paid the supplier immediately. This Buyer paid the supplier right now, immediately, today only. Okay, this was paid immediately. Okay. Now the difference between supplier's credit and buyer's credit is, here this bank is not giving the loan, so this is not there. Only this part is there. So here what will happen? This immediately will not be there. So this supplier will be supplying to this buyer with a credit period. Credit period means the supplier will be supplying for, let's say, 2 months, 3 months duration. Means I'll give you the goods now, you pay me after 2 months. So whenever any goods are sold on credit, on udhari, then that is called as what? Credit directly extended by the overseas supplier. So that is called as buyer, supplier, trade and ECB. Answer is simple. ECB, supplier's credit, right? Again remember, buyers and suppliers are the part of trade credit only. Okay, remember this. Got it? Next one. No person in India can import or export unless she has obtained the following: import export code number from DGFT, authorization for DGFT from DGFT, authorization from RBI, import export code number from RBI. Now this is a simple JIB question. Okay, let me see how many of you can answer this. Got the answer? So it is import export code from DGFT. This IC code is required by each and every person who wants to import or export in India or from India. Okay, compulsory. The supplier's credit extended by the overseas supplier for a period of more than 3 years is termed as. Again confusion in this. Here options are the same again: buyer's credit, supplier's credit, trade credit and ECB, external commercial borrowings. What is it called as? Just now when I discussed a buyer's credit, I told you something. What was that? Think of it. Again, rewind this video. Go back. So, I told you that it is ECB, external commercial borrowing. Whenever any loan is beyond 3 years, it is called as ECB. See here, it's simple. Okay. Below 3 years, less than 3 years, and 3 years and above. What? 3 years over here. Okay. So it is ECB over here, ECB. And this is trade credit, trade. Now this trade credit is of two types: buyer's credit and supplier's credit. Okay, this is a basic classification between all these. So the answer over here is D, ECB, external commercial borrowing. Okay. The decrease in value, foreign value of the foreign exchange rate, which is done during the market due to the market forces, is called as what? So decrease in value of the this foreign exchange, which is done due to the market forces, is called as what? Think over it. What will be called as? Now look at the options: appreciation, depreciation, devaluation and revaluation. Quite simple to answer. Think over it. Think over it. What is the answer? Got it? You'll get confused over here. Decrease in value. Decrease in value means it is either depreciation or devaluation. Either depreciation or devaluation. Now the confusion is between these two only. Is it depreciation or is it devaluation? Now look at this. Foreign exchange due to the market forces. Market forces. Okay. Now this is a trick. This will separate this depreciation from devaluation. So think about this. I'll explain this. I'll give you the explanation also. Not to worry. It is, see here, whenever market forces do anything, it is called as depreciation. Market forces. Okay, I'll mark this over here. Market forces. And devaluation is done when? Then I think so. There's a next question. Let's see. Is it there? Let me see if the question is there. No. So now I'll answer here only. Okay. So if it is done due to the government pressure, government interference, okay, if it is done by the government, in that case it is called as devaluation. Market forces, it is called as appreciation and depreciation. If the price increases, then it's appreciation. If it decreases, then it's depreciation. Okay, got it? Simple. Next one. Which of the following is not the correct value of the domestic currency? Not the correct value. Okay, which of the following is not the correct value? Correct in value, not value. Correct in value of the domestic currency. Devaluation is done by the government. Just now I told you. Revaluation is done by the market fluctuations. Appreciation is caused by the change in demand and supply. And none of the above. Not correct. Think over it again. Okay. What do you mean by not correct? Not correct. Okay. Devaluation is done by the government. Okay. So is this correct? What did I tell you just now? Appreciation, depreciation is done by the market forces. Devaluation and revaluation is done by the government. So this is correct. So this is true. But I want false. So this is not the right answer for me. Revaluation is done by the market fluctuations. This is the catch. Okay. So this is false. Right. Appreciation is caused due to the change in the demand and supply. So demand and supply, that is appreciation, depreciation. So that is true. So we want not correct. Not correct is this. B is the answer. Revaluation and devaluation are done by the government. They are not done by the market forces. Okay. Market forces do appreciation and depreciation. Okay. Again, everyone, subscribe to Officers Adda 24/7 YouTube channel. Also download the this Adda 24/7 app on your mobile. Both the things you should do it now. Okay. Which of the following is correct? Devaluation in value of the domestic currency is caused due to the fluctuations in the demand and supply. Devaluation in the value of the domestic currency is done intentionally by the government. Appreciation is done intentionally by the government. Both A and B. Yeah. What do you think? I'm watching you. What should be the answer? Think over it. In the comment section. Give it in the comment section, everyone. Yeah. What is the answer? Yes, everyone. Devaluation in the value of the domestic currency is caused because of fluctuations. Devaluation is done by the government. Revaluation is done by the government. So this is false, right? So this is false. Devaluation in the value of the domestic currency is done intentionally by the government. Done. True. So one, I got it true over here. Appreciation is done intentionally by the government. Appreciation is done by the market forces. So this is false. Both A and B, that is obviously false. Okay, so the answer is B, only B. Okay, which of the following is correct? Only B is correct. Got it, everyone? So that was the YT series for you. Now before going, let me show you the batches. Here, everyone should join the batch immediately because it is starting on 13th. Okay, 13 means today only. So immediately join the batches. In these batches, you get various numerical. Okay, let me show you first. Let's go to Adda 24/7. I'll always suggest you to go through the app. In the app, you're getting 1% extra using the coin systems. Okay, so go to Adda 24/7 and then click on JIB and CIB. JIB and CIB. Over here, click on CIB June 24. Okay, now you'll see the batches. See this victory batch. Join this batch immediately. This batch, then all the numericals, objective questions, case studies, everything is covered. You get ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, limited size batches. So everything you get it in this batch. Plus, if you look at the discounts, see this 77% off. But I'll give you one more offer. Okay, put the code Y432. Y432. Click on apply. Now look at this offer, 79% off plus 1% extra in the app. So you're getting almost 80% off, right? So that's why join this batch immediately. All the numericals, objective questions, case studies are covered. All the compulsory subjects are covered. You can join the Mahapack as well. In Mahapack, see this, in Mahapack you get multiple batches. See this, CIB Mahapack 2.0. So you get multiple batches on the same subject, plus you get double validity. Means what? You buy for 6 months, you get it for 6 months extra free. Okay. Again, the discount is the same. Y432. Put the code Y432. Now look at this, 79% off plus 1% on the app, plus double validity. So it's a double dhamaka offer in all. Right. So that's why I suggest you to join the batches immediately or join the Mahapack also. Okay.